talking about PAFs or a private ancillary fund. It's not something many people would have heard of.
No, not much of a segue from the previous topic.
Yeah, we've really, so we've gone from redundancy to personal branding to now high net worth individual structuring. So if we want to break down what a private ancillary fund is.
Before we even do that, just so it's not just high net worth, like if you make a donation, it's tax deductible, right? So this is just an extension of that. It's really want to make a lot of donations and save tax and do it in an efficient way where they control the amount and timing of where that money goes, but also control the timing of getting personal tax deductions.
Yeah. So I guess all right, welcome back to the Winners Playbook. Josh here with my regular co-host, Billy. And Billy, I'm going to be taking off on a road trip tomorrow. I'm looking forward to it. Heading over, going to eventually get to Adelaide. Have you done a road trip up through Polo Bay and Great Ocean Road before? Or
We did a couple of years ago with the kids in tow. We stayed at like Big Four caravan parks and we went up to the Grampians, to Halls Gap.
Yep.
And then ended up in as far as Mount Gambier. And that was awesome. Are you going through Mount Gambier?
Yeah, that's I think our fourth stop. So we're doing some real frequent stops there because we've got Leon obviously with us, and so we don't want to get on a long trip at all, like in terms of too big of a leg with no stopping over. So I think the longest trip we're doing might actually be from Adelaide to Halls Gap when we're on the way back. So we're going through the coast to get up there. I think it's Apollo Bay, Port Fairy, Robe, Mount Gambier. I'm probably missing another stop in there. And then we head to a place called Monardo, and then we end up in Adelaide for a few days and then back through to Halls Gap. So I think the biggest journey is like 3.5 hours, so nothing too.
And you got to check out the Blue Lake. That.
Is that Mount Gambier?
Yeah.
Yeah.
Yeah, it's awesome.
I think they've got a couple of other staff were saying some fossils or sinkholes and things and a lot to get into.
Yeah, there's like this massive sinkhole that's full of gardens and stuff. It's really weird. And then they've got the little Blue Lake, which you can swim in, like you can sort of jump into.
Don't know how. It's not heated, is it?
It's freezing.
Thought it might have been one of those. I thought it could have been one of those ones that are, I remember going to, I forget where it was in Victoria, where there was one of like the nuclear reactors or something, and there was a lake and it was like heated from all of what was going on. But that's not one of those. It's more of a Wim Hof type experience.
Yeah.
Yeah, a bit of cold water exposure. Yeah, we'll see how we go. Maybe I could do that and, part of the vlog, I'll jump into Blue Lake and see.
Yep, I'll look forward to it.
We'll see how we go. But what are we going to be covering today? So we're going to do a bit of a market update on what's going on the Australian share market, because the market hasn't really done much over the last 12 months, particularly when you compare it to that of, the US share market as well. We're going to be talking a little bit about redundancies and job cuts and what the options look like regarding that, and how to play that if it is you, or if it's something that may be coming up in your life. Something a little bit different, covering off building that of a personal brand, which is something we've got a bit of hands-on experience ourselves, and some of the work that we've done here at Link Wealth. And then we're going to finish on, again, we've really diversified in our topics today. We're going to finish on looking at something called a private ancillary fund, which is what a lot of wealthy families use to put money in and basically get some tax deductions on the money that they put into it. And then the money gets invested and they have to donate a certain portion of it every year to a charity kind of their choice, because it is restricted in terms of where that money can go. So we've got a lot to cover off. But if we kick off regarding the market update and the Australian share market. So the Australian share market, looking at the ASX 300, I was looking this morning, we're up 0.89% for the last 12 months. The S&P 500 over the same time frame is up 19%. So what are the major drivers there?
Yeah, well, one thing I did want to note is the Aussie share market pays quite high dividends compared to the US. So if you just look at the news and look at the ASX 200 or 300, as you know, it doesn't include dividends. So we're still a fair way behind 19%.
Yeah.
But the data I've got here for the financial year is ASX 200 up 3%, including dividends at 6.3.
Yep.
And then if you go back all the way back to the year 2000, where they started the ASX 200, it's returned 3.9% a year. Then if you add in dividends, 8.3.
Okay, we're getting up there.
Which is, that's roughly what we tell clients.
Long term.
It's sort of like 8-9% is your average return.
Yep.
But in terms of the last 12 months, the US, it's really been a tech story. And I saw a stat that the tech sector has been the best performing sector for the last 7 years in a row, which is its best winning streak since the 60s.
Wow.
So if you invested anywhere except for tech, you generally underperformed, which has made it tough for your stock pickers and active managers and so on, because they typically like to diversify across different sectors.
Yeah. Yeah, so really a few stocks generated most of those market returns. And I was looking earlier at like the ASX sectors. And so looking at, so who are the big winners over the last 12 months? You've got the materials, I believe, up roughly 50% over that. And nothing's really close to materials. But then going down from there, you've got energy, consumer staples, industrials, all sort of hovering around this 10%. But then if we go into negative territory, we've got technology and healthcare down about between 30 to 40% between the two of those. And then there's a couple of big names that have really been punished, which are a part of the ASX 300. CSL, like, they used to be a darling on the market, and they have been absolutely punished in the last few months. I think it's recovered a little bit as of late. I actually owned a bit of CSL a few years ago, and luckily I got out of it for no better reason than that I was trying to get rid of all my direct shareholdings. But it's come off a lot. I think they floated for when they originally listed at like 70 or 90 cents back in the somewhere in the 1900s or 1970s or something. And I think they topped over 300 a share at their peak, and they've come off a lot from there. But, you were saying before, Billy, around tech. So tech over in the US has done incredibly well. What's to go with tech here in Australia? What's happening?
We don't really have a tech sector.
We don't really have too much tech.
It's not fair. We do have a tech sector, but nothing like that. I mean, it's AI, right? AI leading the charge. And it's the world's biggest companies have been the best performing stocks. And so if you buy an index fund, you're fine because they have a big chunk of that in there. But if you're trying to pick stocks and find good businesses and find value, you just have not beaten the index for the last few years.
Yeah.
Now that dynamic won't continue forever. Like, everything works in cycles. But the other thing I've noticed the last couple of years is it's like, remember in when everyone was obsessed with crypto and altcoins and all that, it was like meme investing. Like, something would become popular online, everyone would pile into it. Then they'd lose interest in that. There'd be another new thing, and then that meme stock would plummet and be worthless, and then everyone money and pile into something else. And that's sort of happening in the stock market now. Like, it's gone from Bitcoin to big AI companies to gold and silver, which have now come off, to now semiconductor stocks. And semiconductor stocks have come off, I think, 30% recently. So it's like this populist style of investing. And long term, that does not get you a good result long term, because you're constantly chasing the recent winners, and no one can predict when everyone's going to flee, and you're going to see that negative 30, negative 40%. So it's a weird time to invest, and it's probably harder than ever to like stick to your guns and stick to your strategy.
Yeah, I think what stands true to me there, and I was just having a conversation with a possible client, is it's about like where the attention goes, the money is really flowing. I think we've said that before, but that's really a clear example of this, because then we've looked at, some of those great companies that are out there that like seem like great investments to hold, and they've done nothing, or they've been punished over the last 12 months because all the capital flow has gone towards some of these more shiny objects. And you touched on it a moment ago as well, like indexes, because of that reason, have like dominated over the last 12 months. Like, there hasn't been a great deal of active management, or active fund managers haven't been rewarded at all, haven't probably got the results to show for the fees that they're charging over the last 12 months. So what are your thoughts there around some of that, like that whole index versus active scenario? And for some clients that do hold active management, or people that are looking at it, what would you say?
Well, we should reference the SPIVA report, which, as you know, that's a report where they look at all the active managers out there, and they assess what percentage of those actually beat the index after fees. And it's consistently shown that active managers who are playing in the large cap space, so they're buying stocks in bigger companies, most of them do not beat the index. However, in other asset classes, other parts of the market, active managers do often beat the index. So like in the smaller company space, fixed interest or bonds, they'll often beat the index, etc. So our philosophy as a business is you primarily use index funds for large companies, because we know it's just so hard to stock pick there. But for other parts of the market, the active managers, it's worth paying the fees. And whilst we've seen this trend over the last few years of the biggest companies being the best performing companies, again, that won't go forever. Like, we're in this AI boom, this AI hype era. It'll come to an end at some point. And that's where your other parts of your portfolio will start to give you some good protection, I think, when that unwinds.
Yeah. Well, you've seen, and I was looking at doing a bit of research before we hopped on here as well, around, this semiconductor super cycle, and it's all related to AI and chips and the storage of all of those. And I was absolutely shocked that I found the South Korean share market's up about 170% over the 12 months. At one point in time, it was nearly up 200%, the South Korean index. And yeah, that absolutely blew my mind. But then going further than into that, those returns are predominantly driven by two main companies that make up more than 50% of the South Korean index, which is Samsung Electronics and SK Hynix, which are basically two of the largest memory chip companies. So, keep grabbing on that whole tailwind of AI and everything that we've been talking about. But there's another 900 plus companies in that index, and two of those companies in South Korea make up more than 50% of it, which is absolutely astonishing. And Japan, I haven't looked too hard at Japan, but that's also up around sort of 70, 80% over the last 12 months. So would you be telling people to run out and throw money in the South Korean or Japan stock market bill?
No, you just like diversification is more important than ever, because money's piling into the two companies. Right? At some point, the market will widely agree, hang on, these are way too expensive now. We need to move this money somewhere else. And then, they can do negative 50% when that happens. Or like even SpaceX, right? That's already back below its listing price. Everyone gets excited, money piles in, and then we've all got these short attention spans now. And it's like, oh, stuff that. Now we're going to semiconductor stocks. So the money's flying everywhere. So you just have to be diversified, because you can't predict what's going to be the next big thing.
Yeah, I agree. And I think, unfortunately, for the average investor, what typically happens is they might look at the headline and go, holy crap, what has South Korea done for the last 12 months? Like, God, I got to get on the train. Like, it's all moving. And then how many times I've personally seen it, I'm sure you've seen it, is the average investor piles in after all of the big money's gone in and made all of the profit. Big money rotates, like we said, where the attention goes, the money flows. They look at the next hot thing or want to move money over to whatever it may be. All of the big money and institutions start unwinding, and the poor old retail investors are sitting there and then looking at these massive loss positions and negative, like crypto, great example of all of that. So I think you do have to be a bit careful when you're buying into the hype. There's that whole herd mentality, because really all the smart money got in early, and so if you're jumping in at the top, can be dangerous, I suppose.
Exactly. And on that Spieber report active manager thing, these active managers, these are like, at these fund managers, they have a big team of very intelligent people with a ton of experience with all the tools to analyze the market, analyze data, et cetera, et cetera. They can't beat the index. So what chance have you got as an individual, picking stocks, trying to win? For the vast majority of people, you're better off just buying high growth index fund and doing nothing else.
It's not fun though, Billy.
It's not fun. So you can carve off some dollars for the fun stuff. And you might pick some winners, but to manage all of your wealth that way, it usually blows up. Yeah,
totally agree. Well, if we shift on over to talking about redundancies and job cuts, like we've all seen, clients get made redundant. And so I guess we want to touch on a bit here, so what's happening and why. I think a lot of this is just going to be, again, driven by all of those key themes that we talk about: AI, automation, cost cutting, higher wage costs, economy not doing incredibly well, and businesses, looking at what they're going to be doing moving forwards. But we've seen some big companies go under as well. I don't know if you've got any specific examples there, Billy, or do we want to talk more around, like, if you find yourself in that position where you're going to get a redundancy, where do you start? What do you look at? And then this is probably going to feed into our next topic, talking about personal branding. But what have you seen over the years with regards to redundancies, and any examples?
Yeah, well, I've had a number of clients being made redundant in the last 6 months, and in every case, it was completely unexpected. Like, from what I know, performing well, often been at the company for a long time, Some decisions made higher up and they just get told, yep, you're out. So later, got to the end of the day type thing.
Yeah.
That's happening more and more. The actual data isn't showing a huge amount of job loss, but I suspect there's more job loss in those sort of high-paying corporate roles than usual. The stats here are 268,000 Australians were made redundant in 2025, which is a retrenchment rate of 1.9%. So what's that? 1 in 50 people, I guess. That is higher than it was the few years before that, but it's nowhere near the peak, which was 1991. It was at 7%.
Wow.
So that's like a real recession, like a job loss style recession.
Yeah.
We obviously haven't seen that for a long time. But yes, it does happen. It can happen to anyone. Loyalty is not rewarded anymore by employers in general. So no matter how safe you feel in your job, you should, when you're structuring your finances and all that stuff, like you need to know that can happen and be prepared.
Yeah. Yeah. I've seen some older clients as well and some family members from time to time who have been working at the same job for 10, 20, 30 years plus, and they're like hanging out for the tap on the shoulder to get made redundant.
Some people want it.
Yeah. Some people really want it, but of course sometimes it does come out of nowhere. But which we won't delve too deep into, but when you're getting a redundancy as well, there is a particular formula that works out how the tax is going to be applied on it. So your employer will give you the letter, and then there's a couple of different components, I believe, of the redundancy payment. Like there's one of them which is worked out based upon how many years served, and there's a formula for it, and then that's basically tax-free, I believe, to a limit. And then there's a separate component to that, and then all of your leave and everything else gets paid out on top of it. But I've had a couple of clients in the last year or so get paid out quite healthy amounts of $300,000 or $400,000 clear because they've been at some big banks and some companies for quite some time. But then then it's a matter of what do you do with that money, which I guess we don't need to go too much into what's going to happen there. But if we talk about, how do you protect your family in this type of scenario? Say you're the person where it comes out of absolutely nowhere, or you've got it in the back of your mind, like, I could be made redundant here. And let's say you're not even expecting a very large payout. So it's not like it's going to be a $300,000-400,000 payout at the end of it. How would you be protecting yourself and your family in the event that was to ever occur?
Yeah, well, the number one thing, which is quite simple, is having access to cash. So it's an emergency fund, an offset account, a share portfolio, somewhere where you can access capital reasonably quickly. Even if you don't have any of those things, even a debt facility is probably the last resort. Like if you've got equity in your home, just when you do a refi, just having extra little loans to be made just in case, it's probably the last resort.
Like a line of credit type there.
Yeah. So access to cash if you need it. Knowing what your redundancy entitlements are. As you said, some people it might be, $5,000, $10,000. That's not going to go far. But if you've been with the company for a long time, just knowing what you are entitled to. And diversifying your household income. So that goes to the point of, people who have, for example, employee share schemes, which we've spoken about before. You work for a company, you're the main income earner, you're getting shares to the employee share scheme. You've tied a lot of your household wealth and future to that one company.
Yep.
So investing in other things. And then the last point, which we're going to go into more, is building a personal brand. Right. So that's being, okay, if I lose my job, I know exactly what I can do to pick up another gig quickly.
Yeah, we're sort of really looking at developing those transferable skills, personal brand, building up other streams of income.
The last thing you want to do is you work for a company for 20 years, you lose your job, and you're like, I don't even know what to do.
Yeah,
I've been for a job for 20 years. I haven't been building my network. I don't know who to talk to now.
Yep.
And going on Seek, Seek's nowhere near as effective as it used to be.
Saturated.
Yeah, you go apply for a job and there's
100,000
applicants.
Literally. Yeah, very much.
Yeah, so there's other things you can do to make yourself more employable.
Yeah. Well, the ESOP one's a really good one. I actually wasn't going to touch on that point, but I had a client that had worked at Amazon for quite a few years and was getting all the ESOP, all of the shares year on year, and then left. And because they hadn't vested at that point in time, there was a chunk that had vested that she was able to keep, a large chunk unvested, talking hundreds of thousands of dollars that gone, that kind of thought was going to be theirs, but it ultimately wasn't. So you always got to look out for that if you are a part of any sort of share scheme or structure with your employer. But yeah, I really just had here building a financial fortress essentially. So having cash savings around you, not running it too tight, even having your liquid investments, because you can't just easily sell a property, and you ideally don't want to be forced to sell a property in a short period of time. But that's where you could even have your high growth portfolio, where you might have to just trim down on a little bit of that, pick out some of the funds that have done quite well, maybe trim off a little bit there, or you sell some of the the dogs in the portfolio, so to speak, before end of financial year, and you offset some gains and so on and so forth. So cash reserves, have some liquid investments, and then worst case scenario, that's when you start getting into, do you have to sell a property? Line of credit. Like, I'm always a big fan of, if you release that equity, keep it aside if you can, because then it's always there. But you just got to be careful that you don't end up spending that, which a lot of people could end up doing, which puts them in a worse position. But I had a little checklist here, as well as, like you said, Billy, understanding your redundancy package, checking your entitlements, what's the tax treatment, if real bad case here of can you get on some Centrelink? Like, if you've got no other income coming in, temporarily getting on Centrelink. Clearly spend less than you earn. It's going to go without saying.
Got to cut costs.
It's going to be a lifestyle adjustment, so you've got to get used to that. But reaching out to your network immediately. I've seen some people do this before on LinkedIn, and first thing they do is they announce it on LinkedIn, rather than hopping on Seek or anything of sorts. And then really finding your next job as a full-time job. You got to get out there and you got to get busy.
If you've got a big buffer, you can go, I'm going to do nothing for 2 months and just chill out. I've been working for 20 years. I need a break. That's fine. If you don't have a buffer, you got to get stuck into it.
You got to get busy.
One of the most important things, by the way, which neither of us mentioned, is not burning bridges.
That's very true.
You built up a network in the company that you were at.
Yep.
You might be able to get a new job through that network.
Yeah, I couldn't agree more with that point, Billy, because you might need your old employer to come up for some references, and they're going to be possibly calling your old employer to find out how you were, and you got to be careful of burning those bridges, because that can end that back to
make a very friendly exit. Don't piss anyone off. Well, there might be other people who also were made redundant, like before you, and they've already started the process of building a network, or they found another job, or reach out. You're not the only one in that boat. So just don't annoy anyone. Don't burn bridges. Keep it all friendly. They might have a good relationship with the manager who goes, actually, I've got someone you can speak to and might be able to help you out, all that sort of stuff. That's way better than scrolling Seek and sending off CVs.
Agree. Moving on to building the personal brand. So we're definitely nothing extraordinary, but we've done okay on social media over the years. It's done wonders for our business. And fortunately, I think we got onto it a little bit earlier than some, but some people have been doing this for 10, 20 years as well, mind you. But it's really helped us in our business, and I suppose personally at the same time. And it's something that I actually talk to a lot of other business owners in our space around, is, like really marketing their business, investing in social media, getting their brand out there, because it's generally people doing it because they want leads. Like, they want more leads coming to their business, but it is also brand awareness. And a couple of points I wanted to note is, I really look at social media becoming like a search engine. Is the way, and it's the way I use it. Talked about the Adelaide road trip that we're about to take off on. We came up from, we figured out what we wanted to do from TikTok and Instagram, and then a little bit of AI help in there. Like, we didn't go on Google and ask for anything there. Like, we literally do it through social media with the help of a little bit of AI. So my point being there is, you as a business owner, or you've been made redundant and you're thinking about what your next moves are going to be, you got to really think about where all the attention is going and what the future is going to look like. And social media these days, how people are engaging with businesses and finding experiences and consultants, whatever it may be, is they're looking to social media. Like, they're actually looking to social media to look at the business before going through to them, to see if they've got some online exposure, presence, education. And then the AI part, I think, ties in with that, because we're already getting people come through to us that are finding us from AI. I've had some people come through lately who were literally searching in AI and said, our business popped up. But we only popped up because we have invested in our website and done some SEO, but we've also been investing in social media for the last 6 years as well. And God, geez, how much content would we have out there? It'd be scary to know how many hours of content we've produced over the last six years. So all of that's kind of feeding that ecosystem of online and AI and social media as well. But what are your main points there, Billy? So someone starting out from scratch, building a personal brand, do they need the fancy equipment? Is it going to cost them thousands? Where do they start?
No, let me put it this way. Like, if I had to apply for a job now, I'd barely have to do an interview. because there's hundreds of hours of me jabbering away. So the recruiter or the hiring person who's doing the hiring, they'll just watch some of those videos and they like it or they wouldn't like it.
Yeah.
And that's it.
Yep.
They already know you. So if you, and when businesses are recruiting, the first thing they do is search you, right? On Google, LinkedIn, and probably these days, AI chatbots.
Mm-hmm.
And that's going to pull together everything that exists about you online. If there's nothing there, you're less likely to get the interview. When you do get the interview, they're starting from a place of not knowing anything about you at all. Mm-hmm. And further to your point, just on the like being visible networking thing, if you say, oh yeah, I'm looking for work, and you've already built connections and posted some content and stuff, you can have people reaching out to you about job opportunities.
Yeah.
Now, if someone goes, well, why, like, how do I start? Because I don't want to talk about work stuff. But you don't have to talk about work stuff. You can talk about hobbies. You can do a little travel vlog, whatever.
Yeah.
But people are more likely to watch it, for starters. But secondly, they get to know you a bit. And if they know you and like you, then they're going to keep watching.
Yeah.
And if a recruiter searches you up and sees those videos, you're going to be like, oh, this person seems great.
Yeah.
So you just got nothing to lose. Like, and if you're worried about it, like privacy and things like that, well, none of us really have any privacy anymore. But don't post your kids up and things like that.
Yeah.
But just make sure you've got some new content out there. Your LinkedIn profile's been done properly. You're engaging with other people, etc. It'll make a huge difference if you're ever looking for work.
Yeah, and I think that sometimes people get caught on like, what the hell am I going to actually talk about? So if you think of, 3 ways, and this is kind of how you figure out, new business ideas, is you look at something maybe you're extremely passionate about, something that causes you a lot of pain, whatever it may be, frustration, or something you've just a profession, and you've got some really good skills in. Like if you look at those categories and you can start, mapping it out, you can use AI to help you with a bunch of different prompts and give you, the structure of how to create that content. I think the biggest thing is like it costs virtually no money. Everyone's got an iPhone or a smartphone these days. Those cameras are usually a lot better than like the camera we're actually shooting on right now as well in terms of the quality. So you don't need any fancy equipment. You need your phone. You need to be able to talk to it. You're going to have your structure and what you're going to talk about. And then you just create your accounts, Instagram, TikTok, your LinkedIn's, YouTube, whatever it may be. And then it's a matter of just getting the repetitions up. Like it's never going to be perfect from the get-go. Like I look back at our old videos and like my first couple I seen of mine and, oh, geez, that was rough.
That's right.
They're rough, real rough.
Very hard.
Rough to watch, but you're building up those muscles and the repetition, and then you get better and better and better at it. And it's just consistently, because eventually it's like anything, you punch at it for long enough and you're producing good content, like you're not producing shit, like you are putting out some good content, you break through eventually. And we've all had our moments of that happening.
And like if anyone's listening going, I'm just not going to film myself, I can't do it. You don't have to. You can write blogs, you can write about stuff you've done in your previous role. You can, as long as you've got something there, the people can find you and at least read it, and you made an effort to make connections and engage with other people's content. Like at least that.
Yeah.
I'll say it's sad that some people, there's just no way they're going to film themselves and post it up.
Well, it's always daunting to start.
I thought that before I started doing it.
Yeah, it's super daunting, but once you kind of get over it, but you still always kind of feel like you look a bit weird and sound weird. Like I don't think you ever get over. I'm sure some people will like looking at themselves though. But yeah, like I've seen clients even do it where they left their employment and started their own little business and grew it just purely through social media. Like there was no major ad spend or anything of sorts. Like at home, got a camera, got maybe some lights and things set up, and off they go. You got absolutely nothing to lose.
So Russell Crowe posting the other day.
Really?
About watches, loves watches.
There you go.
So he's an actor, right? Like he doesn't have to do anything. But he literally just loves watches and he wants to talk to other people about watches. So he's posting TikToks of himself and his latest watch. And it's like,
I was gonna say
just something you love or something you're into.
Yeah, well, not planned, but
and you'll actually enjoy it anyway. But then if you're going, job recruiters are looking you up, they'll see your personality and go, oh, this person's interesting. Let's have a chat.
Yeah, I've seen some people on there that have immense, massive followings, and I'm like, wow, like, and they're just clearly being themselves, and they've just grown it. What about we haven't discussed this, but do you have a person you follow, like that's just into some things, or even like a personal interest, or someone you you watch. I've had someone that just popped up recently and their videos are so catchy. But yeah, do you have anyone that you follow that's just
More
perks your interest?
comedy sort of stuff.
Yeah.
Yeah, just funny skits and things like that.
Yeah, right.
There's one guy, I can't remember his name. There's one guy I followed because I liked his all comedy stuff he was doing. I found out he's a financial advisor.
Right. No kidding.
And it's like, yeah, I mean, we're in a client-facing role, so that will help.
Yeah. Well, I was going to say, and this is going to, I remember you had someone come through that had a huge following that was just mowing lawns.
Yes.
And a guy that's been popping up recently on some of my social media feeds, this guy over in the US, and his whole thing is about, there's the laws around when you can start making noise, like in suburbs now. I think it's 7 a.m. on a weekday, and on the weekends it's 9 a.m. So I've done it a few times where it's like 7 a.m. or 9 a.m. on a weekend. And like it's 9:01 and I'm starting to mower up like straight away. I'm the first person in the neighborhood. This guy has made a whole piece about that. So it's like 7:30 on the dot. He's over in the US and he just has a lot of fun with it. But he's got like 500,000 followers. And he would be monetizing the shit out of that now. I guarantee it. And you saw firsthand someone, funnily enough, was actually in the mowing game as well. And they were making immense amounts of money from memory, weren't they?
Yeah, and just like, for privacy, we won't talk about him too much.
Yeah.
He was a total introvert.
Yeah.
Can I just say? And like he's not talking to the camera a whole lot, but just literally feeling himself mowing.
Yeah.
And people love it, right?
Yeah.
What's it called? ASMR. Like it's like relaxing watching it. So you don't even need to front the camera and talk to the camera directly. You can just show whatever hobby or thing you're into. You can just document some of that.
Yeah. Yeah. Like, and that's the thing. I don't think you have to overthink it. Like if you're interested in it, there is guaranteed going to be other people out there that are interested in it. So
exactly, yeah, it can be very niche.
Yeah. That's cool. Any final points there before we shift on?
No, but I think it's just like I said, most people listen to God. I don't want to do it. It's too hard. I don't want to talk to the camera.
Mm-hmm.
But we've talked about this because of like the redundancy thing. I mean, if you're keen to get a job, build a career, maybe uncover a new opportunity you never even thought about or knew existed, or connect to someone completely random, like you've just got nothing to lose.
Yeah. Yeah. And to final point on that is the person I was thinking of earlier who was involved in HR, was quite high up at a company, left the business, started on their own, just started talking on social media and has grown it very well over the last couple of years, literally just by social media, getting out networking events and things of sorts as well, but just started talking about something that she's passionate about, but also really professional at the same time. So I think really good points in there, Billy. Shifting gear into our final topic, talking about paths or a private auxiliary fund. Not something many people would have heard of.
No, and not much of a segue from the previous topic.
Yeah, we've really, so we've gone from redundancy to personal branding to now high net worth individual structuring. So if we want to break down what a private auxiliary fund is and who it's for.
Before we even do that, just so it's not just high net worth. Like if you make a donation, it's tax deductible, right? Mm-hmm. So this is just an extension of that. It's really want to make a lot of donations and save tax and do it in an efficient way where they control the amount and timing of where that money goes, but also control the timing of getting personal tax deductions.
Yeah. So I guess who are they for? I'll maybe start on there and then we'll revert back to some of those points. So I had here, creating multi-generational philanthropic legacy, involving children in deciding which causes to actually support. I've actually seen some people do this. They set up small family offices post a business exit and, you got 15, 20, 30, 50 or $100 million. And then they go, all right, we're going to put this into passive investments. We're going to put this into investing into other businesses moving forward because they're interested in that. And then, so, a third there, and a third to their own sort of charitable cause, start up a private auxiliary fund as well. So you can smooth out those charitable, gifts over the years instead of just making one-off donations. You get tax deductions, particularly in those high income years. And that's where you might have some people exit from business, huge capital gain going on. They look at how they can start minimizing some of that. Well, you could put some money towards a private auxiliary fund and get a tax deduction for it, but that's probably more so of who would it be for? Any other?
Yeah, well, like say you've sold a business and you've got a couple of mil that you want to use for charitable causes. Mm-hmm. By using the fund, it means you don't have to decide straight away where you're going to send that money. But also, once the money's in that fund, you can invest it. Mm-hmm. So it's generating return. And then you can essentially just donate all the returns. And it's all tax-free returns.
Yep.
So it's actually a far more effective way. You're going to be able to help more people doing that as opposed to just going 2 mil, bang, it's gone.
Yep.
That's it.
Yep.
Whereas if you invest it, it's generating returns and you can control the timing of where that money goes to, but
Yep.
still get some tax benefits
Yeah. So
yourself as well.
no income tax, capital gains tax free. So what else we need to then know about that is you have to distribute 5% a year.
Yeah, so I read that's going up to 6.
Is it? Okay.
6% a year. So if the money's invested, you're probably hopefully generating return a little bit above that.
At least. Yep.
And of course, you might be adding to the pool as well along the way.
Yep.
So those are the things you need to know. When you put money into it, I believe you can spread the tax deduction over 5 years.
Yep.
So you put all the money in one go and you could claim that over multiple tax years.
Yep.
I read that I was looking at what's the minimum amount where it's justifiable, and the range seems to be 500K to $1 million, where it makes sense to have your own ancillary fund, as opposed to, say, just directly giving money to charities, or you can do like a sub-fund thing where there's an existing fund you can participate in.
Yeah.
So they're probably the main things to know. And, hopefully this, well, with the federal budget raising taxes on everyone, hopefully that might be a little win that comes out of all of that, because this is how you can save some tax and do some good as well.
Yeah, well, essentially, so it's a trust structure. So there are going to be a fair bit of fees on the front end to get these things set up, for sure. Your accountant's going to be involved.
Compliance, of course, because I want to make sure it's going to legitimate charitable.
Well, that's a fair point. So talking about that, so you have to send out, 5 or maybe 6% of the market value yearly. So say there's $1 million in there, you have to send out 5%, say 50 grand, has to be donated to eligible DGR or deductible gift recipients. So that could be medical research, health and hospitals, education, poverty relief, disaster relief, environmental conservation, animal welfare, et cetera, But some examples of what would be an approved donation, an approved gift recipient versus not. So like the Cancer Council, yes. The Royal Children's Hospital, yes. Local sporting club, probably a no. Your neighbour in financial hardship, what do you reckon, Billy?
I would say no.
No. So your neighbour who wants a bit of money, that's a no. A GoFundMe campaign?
Probably not.
Yeah, probably not.
Sketchy ones out there.
There's some real sketchy ones out there. So I guess the point there being is there are some pretty tight rules around this. So you're not going to be setting one of these up. And look, I'm sure there are some people out there that have maneuvered around and they're getting some money benefit from doing it, other than the tax deduction that they're getting on the front end, because you don't get a tax deduction every year for the 5% either. That has to distribute out. I don't believe you're actually getting a tax deduction for that. You're only getting deduction on the front end when you're putting money in.
Yeah, when you fund it.
Yeah. So, but yeah, I'm sure there are some people that have, through the charitable fund that they've set up, they're getting some other benefits. Not speculating and don't know of any, but I just reckon there would be some of that naturally going on. But I suppose for the right people, and you want to have a bit of wealth behind you, of course, because if you're going to be donating 500 to $1 million away, basically meaning you don't need that because you can't get the money back. You can't lend it to yourself.
So I've got a client who gives $100 grand a year.
Yep.
But she has one charity that she loves.
Yep.
So she doesn't need a fund like that. She just gives $100 grand and gets some tax deduction.
Yeah. And yeah, you're not going to be benefiting your family at the same time as well. So I guess if you're going to be really locking in on it, you've got a bit of wealth behind you to put away 500 to $1 million. But look, if that's something meaningful for you and you can get a tax deduction for it at the same time, and have some control over it, most importantly, where your money goes as well. I think for the right person, it's definitely something worth it considering.
Absolutely.
Yeah. Was there any other points on that one, Billy, that you had?
No. The only other point I had is obviously the ATO is cracking down like they are on everything. So you got to make sure the compliance and stuff is well sorted out. After.
Yeah, squeaky clean. You probably average mum and dad accountant probably won't be facilitating one of these. You're probably looking a bit up the ladder there in terms of someone who's going to be setting up and managing these. And then importantly, the investment side of things will be just as important. So you probably do have a financial advisor who's then going to be managing those investments within the fund, because you want it to be growing. You're not putting it in to lose money year on year. You want it to then grow so you can then donate more and more money. So that could have a mix of, I suppose, depending upon how much money goes in, some shares, managed funds, ETFs, property, commercial. so on and so forth. There could be a multitude of assets that could sit in a private auxiliary fund.
Yeah, well, it's probably why, you hear billionaires and stuff, they don't want to give all their money away because they're like, well, it's better if I control the money. Hopefully they give it away eventually.
Yeah.
But yeah, this makes sense to set up a fund and distribute from there throughout your life. So you can, choose where the money's going each year and see the impact of that and generate a return along the way and save yourself a bit less to the government.
Yeah. Who doesn't want to do that? Well, I think that's all the points we want to cover off. Billy, any final remarks or anything that we haven't ticked off today?
No, all good.
Well, I think we might finish up there. Now, I won't be on the podcast next week, so I don't know who you're going to have on, but I'm sure it will be an amazing podcast.
Okay, bit of pressure.
Bit of pressure. But I'll be back the week after. And we'll see you next time on the Winners Playbook. Thanks for listening to the Winners Playbook. If you've enjoyed this episode, make sure you follow or subscribe so you don't miss the next one. If you got value out of it, we'd really appreciate a 5-star review. Just remember, the information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on anything discussed, consider whether it's appropriate for your circumstances. If you need advice tailored to your specific situation, reach out to the team at Link Wealth. Thanks again, and we'll see you next time.